Okay, let's unpack this. Have you ever felt that real pull to pick the next big stock winner? To outsmart the market, find that hidden gem. It feels pretty intuitive, doesn't it? Like, if you do enough research, maybe get a good tip, you can definitely beat the average, get those incredible returns. But our mission for this deep dive is really to challenge that whole idea. We're going to explore why actively picking individual stocks or even, relying on actively managed funds, well, it just rarely works out for most people. Not in the long run, anyway. It's kind of an illusion, and we're here to figure out why.
Exactly. And guiding us, we've got insights from, well, two real giants in the investment world. We're talking John C. Bogle, the founder of Vanguard, legendary figure, and Benjamin Graham, who most people know as the father of value investing. These are the guys people like Warren Buffett look up to. And what's really fascinating, I think, is that even though they came from different times, different approaches, they land on a strikingly similar message, a powerful one, basically about the futility of constantly chasing superior stock picking performance. So we'll dig into the hidden costs, the ones that quietly chip away at your money. We'll look at our own human tendencies, how they lead us astray, and these powerful market forces that, they make stock picking seem like a mirage for most of us. And ultimately, we want to highlight a simpler path, a potentially much more effective one for long-term investing success.
It's just so natural, though, isn't it? Wanting to chase the next big thing in stocks. You hear these stories, right? Someone gets rich quick. And your brain just connects the dots. Okay, skill plus effort equals outperformance. Like in sports or business. You put in the work, you get the reward. Investing should work like that.
Yeah, that intuition is strong. But it often blurs a really crucial distinction Benjamin Graham talked about decades ago. The difference between actual investing and, well, just speculating. Graham saw these speculative formulas constantly being pushed, things promising quick, easy gains like the January effect, this idea that small stocks always pop early in the year. His point was, look, if a simple formula like that really worked and everyone could do it, poof. The opportunity vanishes instantly because everyone jumps in, driving up prices before anything can happen. So Graham's core principle, really foundational, is this. The average investor cannot deal successfully with price movements by endeavoring to forecast them. Simple as that. Instead, he pushed for investing based on protection, protecting yourself from paying too much, and maybe more importantly, protecting yourself from being overconfident. Overconfident in your own guesses or someone else's about where prices are going next. It's about not letting the market's mood swings dictate everything you do.
And Graham really took aim at what he called new era investment, didn't he? He saw this dangerous trend where how desirable a stock seemed became totally disconnected from its price. People were buying based on hype, maybe an exciting story, not the actual value of the business. He called it a radical fallacy, basically misusing history to guarantee future results, which turns sound investing into just reckless gambling. Sounds kind of familiar today, actually. Okay, so we've got the psychology, the pull towards picking stocks, and Graham's pretty stark warning against just speculating. But the hard truth, well, it often lies in the numbers, right? So when John Bogle, Mr. Vanguard himself, the ultimate numbers guy, looked at all that data on active management, what did he actually find? I mean, about their real performance, especially with mutual funds. Does the data actually show these managers consistently beating the market?
Oh, the data Bogle gathered. It's absolutely devastating for the whole active management idea. And it really boils down to one powerful, often missed factor: costs. These costs, they might look small on paper, a percentage point here or there, but they matter hugely. Bogle called it the tyranny of compounding costs
Yeah.
because it works against you silently, year after year, just eroding your potential wealth. Let's look at Bogle's numbers. If you just compare the lowest cost equity funds, think maybe 0.2% expense ratio to the average fund at 1.5%, or even the high cost ones at 2.2%. The long-term difference is just staggering. He showed a hypothetical portfolio, 65% stocks, 35% bonds. In a low-cost setup, it yielded about 8.6% annually. The high-cost version, only 7.3%.
Wow, 1.3% a year doesn't sound huge, but
Right. But compound that over decades, it turns into this massive gap. We're talking potentially hundreds of thousands of dollars just gone, lost wealth. And that's just the visible cost, the expense ratio. We haven't even factored in the hidden costs, like portfolio transaction costs.
the cost from all the buying and selling the manager does.
Exactly, which happens a lot in active funds. That can silently shave off another 0.5%, maybe even a full percent or more each year. So think about it this way. A typical active fund basically starts the year needing to beat the market by around, say, 3.5 percentage points before any costs, just to match a simple low-cost index fund after all those fees are taken out. That's an enormous hurdle to clear consistently year after year. And this constant pressure to outperform leads to another big issue, this folly of high turnover and trying to time the market. And it's not just the managers doing it. Bogle found that mutual fund investors themselves often get caught up in these consistently counterproductive investment patterns. They jump in and out of funds rapidly.
Chasing performance.
Pretty much. It's astonishing, really. Back in the 60s and 70s, people held onto their mutual funds for like 12.5 years on average. Now it's down to just over 3 years. That's a 31% annual turnover rate by investors. And kind of ironically, the fund managers themselves often lead the charge. Their average portfolio turnover, it shot up from a pretty modest 17% back in the 40s to 60s to 85% by the late 90s.
85%. So they're holding stocks for, what, just over a year?
Barely. This rapid-fire trading, as Bogle called it, just heaps more transaction costs and, importantly, tax costs onto the investors. As one law professor pointed out, many managers get obsessed with momentary stock prices, and they miss the bigger picture, the actual nuances of the business they supposedly own. It's like trying to win a marathon by constantly sprinting and changing direction. And maybe the most fundamental killer for active management is this relentless force called reversion to the mean. Bogle put it very bluntly. No evidence, none that superior past performance is predictive of future success.
None. That seems harsh.
It is, but the data backs it up. Need an example. Legg Mason Value Trust. Famous fund. It beat the S&P 500 for an incredible 15 years straight, 1991 to 2005. Unbelievable run. But then, from 2006 to 2008, it fell behind the index by a staggering 43 percentage points. 43.
So the magic just disappeared.
It reverts to the mean. And it's not just one fund. Look at the broader trend. 73%, almost 3/4 of the top-performing general equity funds from the 1990s. They ended up performing at or below the S&P 500 index in the following decade. Even those popular Morningstar star ratings, Bogle found they have little predictive value. Studies actually show that if you try to trade based on them buy the 5-star funds, sell when they drop, you actually end up with below-market returns and above-market risk.
So even the star system doesn't really help you pick future winners.
Nope. That relentless pull towards the average is just incredibly powerful.
Okay, that data is, well, it's pretty compelling. But I can almost hear some listeners thinking, okay, but what about those super rare managers who do seem to beat the market? Or, the legends like Warren Buffett himself. He actively picks stocks. How do Bogle and Graham's ideas square with those outliers? And maybe more importantly, if all this active chasing is usually, as you say, a losing game, what's left? What's the alternative for the average person trying to invest? Is there a simpler way that actually works?
That's a really important question. And yes, we have to acknowledge the outliers exist. A tiny, tiny fraction of active managers do outperform for periods, but finding them before they outperform, virtually impossible. And sustaining that outperformance, extremely rare. Buffett, as you mentioned, he's really an anomaly. A genius, yes, but he also operates with a unique long-term business owner mindset. Most fund managers just can't replicate that structure or patience. So for the vast majority of us, the answer, championed so effectively by Bogle, is surprisingly simple. Passive investing, specifically using broad market index funds.
Bogle's big innovation.
His big innovation. He created the very first one back in 1975. People laughed, called it Bogle's folly. But its performance, truly remarkable. Over a 15-year period, Bogle studied. A simple total stock market index fund beat the average diversified active equity fund by 2.5 percentage points every single year, on average.
2.5% doesn't sound like much each year.
Again, it's that compounding. But look at it this way. The capture rate. The index fund captured 99% of whatever the market returned each year. The average active fund, only 87%. That 12 percentage point gap in how much of the market return you actually keep might seem small year to year, but it's where that tyranny of compounding working against the active guys really bites.
Right. It's like leaving 12% of your potential gains on the table every year.
Exactly. Over decades, that small gap becomes a monumental difference in your final wealth. To make it concrete, Bogle showed a $10,000 investment in an index fund could grow to $153,100 over a period. The average managed fund. Same period, same initial investment. Only $113,700.
Wow, that's almost $40,000 difference just from costs and underperformance.
$40,000 you'd just be missing out on. And it's not just about higher returns. Broad market indexes, by their very nature, carry substantially lower risks than active funds. Why? Because they aren't concentrating bets on a few best ideas. They spread the risk across the entire market. Plus, index funds are way more tax efficient.
Because they don't trade much.
Precisely. Low turnover means fewer sales, which means fewer taxable capital gains distributions passed on to you, the investor. Active funds, churning their portfolios, they generate way more taxable events. Bogle pointed out, for example, the Vanguard S&P 500 fund beat 94% of its peers before taxes. But after taxes, it beat 97%. That tax efficiency adds even more to your real-world return.
And what's really amazing is how even the legends of active stock picking seem to agree now. Peter Lynch, right, ran the Magellan Fund with incredible results. He now says most investors would be better off in an index fund. Even Charles Schwab, whose company makes money from people trading active funds, champions the power of indexing. He admits only about 1 in 4 active equity funds actually beat the market. It really feels like the industry is finally catching up to what Bogle was saying all along.
It absolutely does. Now, we should quickly mention modern variations like ETFs, exchange-traded funds. They're popular, and while many ETFs do have lower expense ratios than traditional active funds, they often carry, believe it or not, 3 to 4 times the internal costs of classic broad market index funds like Vanguard's original.
So even within passive, there are cost differences.
Big time. And the data shows ETF investors often trail the performance of the very sectors their ETFs track, sometimes by significant margins like 4.2% per year in one study over 5 years.
Why is that? People trading them too much.
It seems so. It just goes to show that even with passive tools, avoiding the temptation to constantly trade or try to time specific sectors with specialized ETFs is still critical. The simple, boring, broad market index funds. They remain arguably the most powerful tool for most investors.
Okay, so wrapping this deep dive up, the big takeaway for you listening right now in your investing journey seems pretty clear. Investing doesn't have to be super complicated. And it definitely doesn't require trying to outsmart everybody else. It sounds almost too simple, though. What's the catch? What's the hardest part, then, about actually sticking to this simple approach?
Yeah, it feels too simple, right? Because it cuts against that grain, that human desire to do something, to be in control. But let's go back to Graham's core idea. A stock isn't just a flashing ticker symbol. It's an ownership interest in an actual business. It has an underlying value, separate from its day-to-day price swings. The market. Graham called it a pendulum, always swinging between crazy optimism, making stocks too expensive, and unjustified pessimism, making them too cheap.
Buy from the pessimists, sell to the optimists.
Exactly. The intelligent investor is a realist who does that, rather than chasing the pendulum or trying to guess its next swing. The hardest part, often, it's just doing nothing. Resisting the urge to act when your emotions are screaming at you during market turmoil or euphoria. And building right on that, Bogle laid out those core principles for success so clearly. First, invest you must. The biggest long-term risk isn't market crashes, surprisingly. It's the risk of not being invested at all, of letting inflation eat away at your savings. Second, time is your friend. Compounding is like magic, but it needs time to work. Start early, even small amounts make a huge difference over decades. And third, crucially, impulse is your enemy. Get emotion out of your investing. Have rational expectations. Don't get wildly bullish when things are hot or hopelessly bearish when things are cold. Stay the course. Stay the course. As Bogle said, those cold, dark market winters always give way to bright, bountiful springs if you just hang in there.
It's such a powerful message, isn't it? The secret to investing, as Bogle famously said, is that there is no secret. But why is that idea both so incredibly powerful and yet apparently so hard for so many people to really internalize and stick with? It really goes down to embracing simplicity, doesn't it? Ruthlessly minimizing those costs we talked about, getting broad diversification across everything, and then just patience, discipline, sticking with it. So here's a final thought to leave you with. If that tyranny of compounding can work so powerfully against you through high costs, just imagine the quiet, relentless power it wields in your favor when you keep those costs absolutely minimal. What could you actually do with all that extra wealth accumulated over decades?
Yeah, we really encourage you to maybe explore these foundational ideas a bit more on your own. True financial success, it seems, often isn't found in chasing the next hot tip or complex strategy. It's usually found in embracing these timeless, common-sense principles. Principles that have really stood the test of time and, as we've seen, the test of hard data.